Let's begin by introducing the concept of chart types and their role in trading. Charts are visual tools that help traders analyze price movements over time. They offer a simple yet powerful way to detect trends, spot patterns, and ultimately make informed trading decisions. Different chart types highlight different aspects of market data. For example, some focus on overall trends, while others emphasize short-term price action or daily fluctuations. Understanding these distinctions is key for traders, as it helps them interpret market behavior more accurately. In this lecture, we'll explore three of the most common chart types: line charts, bar charts, and candlestick charts. Each of these charts serves a unique role in technical analysis, and by the end of this session, you'll know when and how to use them effectively. Let's start by exploring line charts, one of the simplest and most widely used chart types in trading. A line chart connects the closing prices of a security over time with a continuous line. It's easy to interpret because it focuses on just one data point per time period, the closing price. Why the closing price? Because it's often considered the most significant price, reflecting where the market settled during that period. Now, let's go over its key characteristics. First, it plots only the closing price, making it less cluttered and easier to read compared to other chart types. Second, it provides a clean and simplified view of the overall trend, which is why it's perfect for quickly spotting long-term trends. And third, it's commonly used for long-term trend analysis in markets like stocks or indices, where short-term fluctuations might not be the main concern. One important thing to note: since it ignores intraday price movements, it's not ideal for day trading or short-term analysis. However, for a quick understanding of where the market has been over time, line charts are extremely useful. We'll dive deeper into when and where to apply this in trading strategies later in the lecture. Now that we've covered the basics of line charts, let's dive deeper into their strengths, weaknesses, and when to use them in practice. Let's start with their strengths. First, they're easy to read and interpret, making them beginner-friendly and ideal for quick trend recognition. Second, they're particularly useful for long-term trend tracking since they strip away short-term noise, allowing us to focus on the bigger picture. However, line charts do come with limitations. They ignore intraday fluctuations and any volatility within a single trading session. This makes them less effective for short-term or day traders who rely on high-frequency price changes. They also have limited use for short-term or day trading, where you need detailed information about open, high, and low prices. So, when should you use line charts? They're perfect when you want to analyze the closing price for each time interval, especially when evaluating trends over weeks, months, or years. They're also ideal for beginner traders, or any situation where simplicity is preferred, such as when looking at overall market direction without getting overwhelmed by details. Overall, line charts are like the big picture view in trading. They provide clarity, but when it comes to complex price action or short-term trading, other charts like bar or candlestick charts may offer more insight. Now let's move on to bar charts, which are more detailed and commonly used by traders who need additional information beyond just the closing price. A bar chart, also known as an OHLC chart, short for open, high, low, close, offers a more comprehensive view of price movements within a specific time period. Instead of a simple line, each bar represents 4 key data points: the open price, which is where trading began for that time interval; the high price, representing the highest point the price reached; the low price, showing the lowest point within that time period; and finally, the closing price, where trading ended for that interval. Unlike line charts, bar charts provide valuable insight into the entire trading range of a session, not just where prices closed. This makes them incredibly useful for day traders or technical analysts who want to understand the strength or weakness of price movements throughout the day. A quick tip when reading bar charts: if the closing price is above the opening price, the market had a bullish session. If the closing price is below the opening price, it was a bearish session. This extra layer of detail allows traders to see potential reversals or momentum shifts that might not be visible on a line chart. Now let's break down the strengths and weaknesses of bar charts and how to interpret them effectively. Strengths. One of the key benefits of bar charts is that they capture detailed price data within each time period. This makes them highly useful for understanding market activity beyond just the close. They're versatile and are equally useful for both short-term and long-term trading because they show critical price movements, from opening to closing, with the highs and lows included. However, bar charts also have some weaknesses. For beginners, they can be visually overwhelming due to the amount of data on display, especially when analyzing short time frames. They're also considered less intuitive than line charts, meaning they require more practice and training to interpret effectively. Let's talk about a key characteristic. Each bar displays the range between the high and low prices, giving you a sense of market volatility and movement. The position of the open and close prices within the bar helps indicate market sentiment or direction. For interpretation, you'll want to look at the relationship between the open and close prices. If the close is above the open, it's a bullish bar, signaling that buyers were in control. If the close is below the open, it's a bearish bar, suggesting selling pressure. This ability to quickly assess whether a session was bullish or bearish, combined with detailed price movement data, makes bar charts an essential tool for many traders. Next, let's discuss candlestick charts, which are among the most popular and widely used chart types in technical analysis. Candlestick charts combine the detail of bar charts with visual clarity, making it easier to spot patterns and market trends at a glance. Each candlestick represents 4 data points within a time interval: the open price, where the market started; the high price, showing the peak during the period; the low price, indicating the lowest price traded; and the close price, where the market ended. The body of the candlestick represents the difference between the open and close prices, giving you a sense of whether the session was bullish or bearish. If the closing price is above the opening price, we typically see a hollow or green candle, indicating bullish movement. If the closing price is below the opening, we see a filled or red candle, signaling a bearish session. Above and below the body, you'll find the wicks or shadows. The upper wick shows how high the price reached, while the lower wick shows how low it went during the session. These shadows provide key insights into volatility and potential reversals. The advantage of candlestick charts is that they offer all the information of bar charts, but with better visual cues, making it easier to identify market sentiment, reversals, and price patterns like dojis, hammers, and engulfing patterns. Let's now look at the strengths, weaknesses, and how to interpret candlestick charts effectively. Strengths. Candlestick charts are easy to interpret visually. The use of color-coded bodies and wicks makes it simple to see market direction, volatility, and potential turning points. They're also excellent at showing both trend continuation and potential reversal signals. This is why they're so widely used in technical analysis to identify opportunities. However, candlestick charts aren't perfect and have some weaknesses. They can be complex, especially when you're trying to recognize patterns like dojis, hammers, or engulfing patterns. They also require some training and experience to interpret patterns correctly, which can be overwhelming for beginners at first. Now, let's cover the key characteristics for interpreting candlesticks. A filled or red candle indicates a bearish session, where the close is below the open. A hollow or green candle indicates a bullish session, where the close is above the open. For quick interpretation, if the close is above the open, the candlestick signals a bullish session, showing that buyers dominated. If the close is below the open, the session was bearish, indicating selling pressure. The combination of these signals allows traders to identify potential reversals, continuations, or periods of indecision. In the next section, we'll explore specific candlestick patterns to help you recognize trading signals in real time. Let's wrap up our discussion on candlestick charts by looking at three common candlestick patterns that traders use to identify potential trading opportunities. The first pattern is the doji. A doji forms when the opening and closing prices are almost equal, resulting in a very small or non-existent body. The upper and lower shadows, or wicks, may vary in length. This pattern typically indicates indecision in the market, where neither buyers nor sellers are in control. It's often seen before a potential reversal or continuation of a trend, depending on the context. Next, we have the hammer. A hammer forms after a downtrend and is characterized by a small body near the top of the candle and a long lower shadow. It signals a potential reversal, where buyers regained control after significant selling pressure earlier in the session. The longer the lower wick, the stronger the potential for a bullish reversal. Finally, the engulfing pattern. This pattern involves two candles, where a larger bullish or bearish candle engulfs the body of the previous one. A bullish engulfing pattern occurs after a downtrend and suggests that buyers have taken control, signaling a potential upward reversal. A bearish engulfing pattern occurs after an uptrend and can indicate a reversal to the downside. Recognizing these patterns can help traders anticipate potential reversals or trend continuations, but it's important to combine them with other indicators or analysis for confirmation. Let's take a moment to compare the three chart types, line, bar, and candlestick charts, so you can better understand their differences and when to use each one. We'll start with the data points displayed. A line chart only displays the closing price, making it the simplest of the three. Both bar charts and candlestick charts display four key data points: open, high, low, and close, offering more detailed price information. Next is simplicity. Line charts are highly beginner-friendly because they reduce market information to its core trend. Bar charts provide more detail, but they can be a bit harder to interpret, especially for beginners. Candlestick charts strike a balance by combining detailed information with strong visual clarity, thanks to color-coded candles. For ideal use cases, line charts work best for long-term trend tracking, especially when you want to avoid the noise of daily fluctuations. Bar and candlestick charts are suitable for both short-term and long-term trading, as they provide more information on intraday price movement. Finally, let's look at visual intensity. Line charts have low visual intensity because they are simple and clean. Bar charts fall somewhere in the middle. Candlestick charts have high visual intensity due to their color coding and wicks, which help traders identify patterns and market sentiment more easily. Overall, the chart you choose depends on the trading strategy and the level of detail you need. For quick, high-level analysis, line charts may be enough. But for day trading or technical analysis, you'll want to rely on bar or candlestick charts for their depth and pattern recognition. To wrap up this lecture, let's quickly revisit the key takeaways from today's session on chart types. First, line charts. They're perfect for simplicity and long-term trend analysis. By focusing on the closing price, they give a clear view of overall market direction while avoiding short-term noise. However, they're less effective for analyzing day-to-day fluctuations. Next, bar charts. Bar charts provide detailed data by showing the open, high, low, and close prices. They give traders a complete picture of market activity within a time period. While they're useful for both short and long-term trading, their complexity can be a drawback, especially for beginners. Finally, candlestick charts. Candlesticks are ideal for price action analysis. They combine data richness with strong visual appeal by using color-coded bodies and wicks. They're especially helpful for identifying trend reversals and market sentiment, making them a go-to for many traders. Remember, no single chart type is superior to the others. The right choice depends on your trading goals and the level of detail you need. As we move forward, we'll explore how to combine chart analysis with technical indicators and patterns to enhance your trading strategies.